back to the show, everyone. We both do not need any introduction as you have watched us before. If you are new to the podcast, well, welcome. Please do like, subscribe, and hit the bell icon so you do not miss important topics in the future. Today we are tackling a question that hits inbox after inbox, especially in today's housing market. So the question is, can I actually buy a home in Canada if my credit score is far from perfect? Shawn will be helping us with that. Shawn, what do you think?
Wow, it's a huge concern, and it's a concern I guess realtors and mortgage agents both share, because right now in the housing market, we're seeing prices balancing all the way from home prices balancing all the way from Ontario to British Columbia. A lot of buyers are just feeling stuck.
Yeah.
Everybody's monitoring the interest rates, and while they see interest rates stabilizing after what has been just a roller coaster year, they look at their own credit score, maybe a 580 or even a 620, and think the banks are just going to laugh at me, and they're going to just laugh me out of the room. Actually,
and the short answer is no. You are not locked out, but the rules of engagement are very different than they were a few years ago, right? And it has changed a lot, especially what was happening in 2005 to 2015. You cannot just walk to the big 6 banks with a bad credit and expect an A-lender interest rate. You need a playbook. So we are here to help you with that playbook. Number 1, understanding the Canadian credit tier system. So Shawn will be helping us explaining A lender, B lender, private mortgage categories, which for a lot of people, somehow they know it, but it's blurry. What do you think? Yeah.
So generally, lenders break applicants into 3 main buckets.
Yeah.
Right. So we'll talk about the A lenders. These are the big banks, big 6 banks, the credit unions. And if you want an insured mortgage, which simply means putting less than 20% down, the absolute floor your credit score is 600, but realistically for standard uninsured at the bank rates, major banks are looking for about a 680 or higher, sometimes even 660. So B lenders now, these are alternative lenders like trust companies, you've probably seen Home Trust and things like that. This is a sweet spot for credit scores between 550 and about 679. They specialize in alternative underwriting. They specialize with bruise credit, not always bad, but bruise credit. And they also work with a lot of self-employed individuals and individuals really just rebuilding their life. Then you've got your private lender category, right? So if your score is under 500, they work with, very bad credit as well as some past bankruptcies. These guys tend to mainly look at home equity as a way of underwriting and approving you for a mortgage.
Yeah, so here's the reality check for 2026. While the Bank of Canada policy rate has settled down, there might be some variation. Alternative and B lender rates carry a premium. B lender typically charge about 1 to 2% higher than prime bank rates, plus standard lender fees. So if a prime fixed rates are sitting around 4%, a B lender might sit at 5.5 to 6%. Number 2, we look at, because we're talking about rates, is the stress test factor and down payments. We cannot forget the federal mortgage stress test. In Canada, under OSFI B20 guidelines, federally regulated lenders have to qualify you at your contract rate plus 2% or 5.25%, whichever is higher. They were looking at some changes to it, however, currently it stays.
I don't think it's going away anytime soon, by the way.
So there you go. That means if your bad credit pushes you into a higher interest rate, with an alternative lender, your qualification threshold moves up too. Your GDS, which is gross debt service, and TDS, total debt service, ratios get squeezed fast. So Shawn, how do you offset bad credit in this market?
Well, there's a couple of levers that you can take a look at in controlling that's within your control. And, I'll break it down into 3 for you. So the first lever is a larger down payment, right? Typically if you throw a lot of money at something, somewhere in the mix it fixes itself. So if your credit score is under 600, and you're looking for like minimum down payment options, like, usually the 5%, what you want to do is you want to try to get a larger down payment and move it closer to 20% down.
Okay.
That's going to open up more lender opportunities and options. And frankly, the more you could put down can also offer you different products as well too within some of the alternative lenders. The second lever that you can control, or you can help yourself with, is finding a cosigner. Finding somebody that has maybe a higher credit score than you. That typically helps strengthen your application for for your big banks if you're looking to get into them. And then sometimes, and the last lever that you want to kind of control is how you're getting into it, or what your financial profile looks like before you apply. And that's just simply cleaning up some credit. So if you got some credit cards that need to be paid off, pay those off so you have no servicing ratios going into the application.
Yeah. So let's look at a strategy. Let's say we plan 12 to 24 months and we talk about playbook earlier. Actually, it's a strategy. If someone is sitting with a 580 credit score today and wants to buy a home, what should their game plan look like, Shawn?
So here's the thing with strategy, right? Strategy, when we think about strategy, it's more than one play.
Yeah.
So when I think of strategy, I think of a B to an A bridge strategy.
Yeah.
So you don't want to stay with the alternative lenders and private lenders forever.
Of course.
What you want to do though is you want to use them to get into the market. So you typically a 1 year, 2 year, or even a 3 year short-term mortgage with a B lender as a temporary bridge. And during that time frame, you want to be able to improve your situation, whatever it is, during that time frame. And pay every single mortgage payment as much as you can, build strong credit over time, and keep your credit card balances about under 30% of their total overall usage.
Definitely.
Another thing that I would strongly recommend is during the time of rebuilding is don't take any large car loans. Don't get into any big consumer debts. Use this time to typically rebuild during this bridge strategy period.
Yeah. So moving the credit from 610 to 680 usually takes less than 12 to 18 months. And this will only happen with discipline, as Shawn said. When your mortgage term comes up for renewal, you refinance or switch to an A lender or prime market rates, as you said, prime market means big banks. So key takeaways for everyone. To wrap up today's episode, bad credit in Canada isn't a dead end. It is just a detour. Check your actual credit report on Equifax or TransUnion and look for errors. Sometimes things are there that we do not realize, but we can easily clarify or clear them. With an independent mortgage broker like Shawn, who has access to multiple B lenders and private channels, rather than just one bank, it's usually beneficial to look at whole picture. Have a clear exit strategy to transition back to prime rates. So if you found this breakdown helpful, hit the subscribe button, drop a review, which we are honestly looking for any questions, and share this episode with anyone currently navigating the Canadian housing market. Trust me, right now a lot of people are in this situation, and your sharing will be caring. Thank you for tuning in, and we'll catch you at the next episode.